Platts. So when you guys see this, which class? They have equity. Okay, fantastic. You see this in equity. So I guess not everyone has taken equity class over here. So let me go over what this, why this is important for us again. Okay. NOPAT stands for net operating profit less adjusted tax. Okay. NOPAT has a cousin. Net operating profit less adjusted tax, NOPLAT. It has a cousin called NOPAT. Stands for the same thing. Net operating profit after tax. Okay, so operating profits. If you want to go back and look at the financial statements, what line would you say represents operating profit of a company? So there are a few lines we can talk about. Revenue. And if you deduct, say, cost of goods sold, gross profit. Let's say you also deduct SG&A. Going to get EBIT and deduct interest, and tax. You get net income. Which one of these would you call operating profit? EBIT, okay? Good. So EBIT after tax. Or EBIT stands for earnings for interest and tax. If we have EBIT after tax, it means we're skipping interest payment. So why might we want to skip interest payment? What's the issue with interest payment? So what I asked you, let's evaluate how profitable a company is. How might you want to evaluate the profitability of a company? So earlier you said company makes some profits, and you said, oh, it depends on the profit margin. Right? So you could match net income to revenue and get, say, net profit margin. That's what you could do. How else might you want to compare profitability? You can compare net income to, say, assets. Okay. You have net profit margin. Compare this to sales. If we compare net income to not sales, let's say assets, we call that ROA. We also compare this to equity, we call that ROE. All right, so let's compare two companies. You have company A, company B. Company A and Company B look exactly the same in terms of assets it generates. Sorry, asset it has. identical in every way. Okay, same assets. When I say same sales, same cost structure. So in terms of profitability measurement, okay, we're gonna want to say that they're both the same. But if I give you information that company A has no debt, and company B uses debt, and I ask you compare the net profit margin ROA and ROE of these two companies. First of all, ROE. Okay, company A no debt, company B uses debt. Which one has higher ROE? B, right? Because you use debt. Usually, when you have leverage, okay, your profitability in terms of equity efficiency, it goes up. You use less equity, okay, but same company. Okay, so for this, B. What about ROA? A and B, identical assets. Which one has higher ROA? Or are they the same? The same? No. Same sales, same cost structure. One has debt, one has no debt. One has interest, one has no interest. Which one has higher net income? A, because A has no debt. No debt, no interest expense, more net income. ROA of A is greater than B. And same thing, net profit margin of A is greater than B. Next question, should they be different in the way we evaluate the companies? If they're identical, except in their financing structure, in the metric that we choose to evaluate them, do we want them to come out the same? We do, right? But what we learn from normal accounting says, no, actually it doesn't come out the same, because net profit is a combination of how your operating results are and what your financing structure looks like. Same operating results, different financing structure, sorry, different net income. Even though your assets are identical, but one has debt, one has no debt, they're not the same. Right? So ROA is actually very problematic, because for two companies, they're supposed to be identical in their operations, identical in their operating profit margin. Their EBIT margins are the same, but their profit margins are not the same. Their ROA are not the same. So using net profit margin and using ROA is a little problematic for us. So that's why I want to say, you know, if two firms are identical in their operating performance, then everything down to this part, this is their operating performance. Let's stop here, because things that come after this is financing. We don't want this. So that's why we pretend, well, it doesn't, I don't really care how the company is financed, but one has debt, one has no debt, but both have equity. So let's pretend our company has no debt at all. Let's pretend our company is financed entirely with equity, just for simplicity's sake, and then evaluate how profitable our company is. And that's what NOPAT is. NOPAT or NOPAT, okay, depending on where you're from. If you are from McKinsey camp, you're gonna call this NOPAT. If you're from other camp, you might call this NOPAT. Same thing. Just different companies, you can't have the same names because you're rivals, but otherwise they really mean the same thing. You calculate the profit after deducting tax, pretending you have no debt. Another name you might want to call this, we call this unlevered net profit. And pretending your company has no debt, zero leverage, this is what your net profit would be. Okay, therefore your usually is EBIT minus interest times 1 minus tax. But since our interest is 0, it reduces down to EBIT times 1 minus tax. That's how we want to measure profitability of the company. All right, now we can go back to the picture we had on the slide earlier. This is how much the firm's operations is able to generate. How much investment did you make in the firm's operation? That's the invested capital that we looked at earlier. So let's compare this profit to the firm's capital and call that return on invested capital, ROIC. If you look at consulting companies' websites, McKinsey, BCG, Bain, Mercer, Deloitte, and so on, when they benchmark how good a company is doing, they never mention ROA. They would mention ROIC. Sometimes they may mention ROE, but mostly ROIC. We're going to see in a moment why ROIC makes a lot more sense to us. Okay, so this is the after-tax profit the firm generates. You can measure that in terms of efficiency, compared to the capital that you require. So the higher ROIC, the better. So if you were using ROA, think of that as an alternative to ROA, where the numbers are now comparable across firms. Independent of their financing strategies, if this firm is good, the ROIC will be high. And this ROIC is now comparable across firms because we're not incorporating the capital structure decision in here at all. So keep this at the back of your mind. It's a way of term we want to be using this class, hopefully. By the way, some people call this ROC or ROCE, return on capital, return on capital employed. They mean the same thing. Okay, ROIC, ROC, ROCE, same thing. Synonyms for the same stuff. Okay, so we have profits. The next issue is not all profits that we generate can be returned to our investors, because we need to make investments in the company. We're not going to label what these investments are, but let's just say we need to spare some of that profit for reinvestment, like we saw earlier in this class today. So let's deduct investment. It turns out investment can be made in only two things: either investment in your long-term assets, or investment in your short-term operating assets. So your reinvestments are going to go into either this component or that component, depending on your need. Once you make that investment, the rest you can now distribute to your investors. We call that free cash flow. It is now free because there's no obligation, okay, nothing encumbering the use of that. You can do whatever you want with it. So either you pay that out to your investors, okay, you pay that to your creditors, interest. You pay that as repayment. You pay dividends. Use that to buy back. And if you don't feel like paying out at all, you can actually keep that on your balance sheet as excess cash. Keep accumulating it if you like, but it's free for you to do whatever you want, and then return to your capital owners. Free cash flow. Okay, next, let's define reinvestment rate as however much you invested. So the change in invested capital. Okay? If invested capital grows, it means you put your money back into the company. So let's define that amount and then compare that as percentage of the profit that you have, your NOPAT. So if you make 100 million profit and I reinvest 20 million, that means I reinvest 20%. Okay, that'll be a percentage ratio. Similar to what you learned in your equity class and in your financial class for stock valuation, okay, you learned that growth equals ROE multiplied by plowback. We're doing very similar things, except what we put on top and the bottom are not at the equity level. Okay, we do this at the firm level. So at the equity level, we have net income. That's what shareholders get, sure. We also have the equity in terms of book equity bar. But at the firm level, you expand that to include debt as well. So debt plus equity becomes the whole firm value, and the thing that you get to give back is not just the It's not the net profit anymore, because net profit implies you pay back your debt capital. So you add that back, you get the NOPAT. So replace ROE with ROIC. Replace the plowback rate with the investment rate. You get the same thing. Okay, sustainable growth equals investment rate multiplied by ROIC. Then you do the usual valuation, like on a growth model, but instead of using dividend, you use free cash flow. Instead of using the cost of equity, you use the weighted average cost of capital and the growth rate we had earlier. So enterprise value equals the cash flow discounted as a growing perpetuity. Then make some substitutions. Because NOPAT equals ROIC multiplied by invested capital, okay? And also free cash flow equals NOPAT minus change in invested capital. So make a few substitutions in this formula from the variables we had earlier. You're going to get this expression. Okay, so I'm going to write about this expression. I'm going to leave the little proof for you to do in your own time. But I would like to focus on this expression instead. Enterprise value is how much your firm is worth. Invested capital is how much you put in. You can finance your invested capital using a combination of debt and equity. If what you put in is now valued at a greater amount than what you put in originally, the value of the firm is greater, then this grows in value. Now let's look at who gets to claim on this. Okay. The claimants on this are debt and equity. As we said earlier, debt claimants, as long as all their payments are being made in full, is invariant to how well the firm is doing. I can do really, really well, but the most I get to claim, as long as I'm making the payments in full already, it's just the amount I promised. This box remains the same in size. If the original equity you put in is carried over in size too, then the increase is a value created, which you may have seen. That's the NPV of this investment, the NPV of creating this business. So you want to maximize shareholder value, you maximize the NPV of your investments. And to maximize the NPV of your investments, you maximize this square bracket expression here. So the next question is, how do we maximize this? We want this to be as big as possible. You can do, suppose I call this M. Okay. You can do the MDG. Right? See how this M responds to different levels of growth rate. What you're going to get from here is that the MDG is actually not signed. It depends. Depends on, you may have guessed, the gap between ROIC and R. You can do this in your own time. Take the partial differentiative of this expression with respect to G, and you find that it's actually the direction of this is not clear. It's greater than 0 if and only if ROIC is greater than R. So what does this tell us? It tells us two things. A good business isn't a business that is growing fast per se. To know whether this business is good or not depends on, number one, the gap between ROIC and R. If your ROIC is good compared to R, which is the cost of capital, you are deploying your capital in a value creating way. You should do this. If this first condition is satisfied, then grow as fast as you can. So, companies that grow really fast isn't necessarily creating value for shareholders. The main prerequisite for value creation is in the ROIC. So firms should really maximize ROIC. Another way to say is firms must maximize ROIC. And this ROIC, of course, should be as great as possible. Should maximize ROIC minus R, sorry. Maybe a better expression. Increase your ROIC or decrease your R. Either way, you're creating value. We can call this I called this earlier investor supply capital. And left hand side, I call this the market value balance sheet. So this is the most important tool in finance. If you can draw the market value balance sheet and then see, are you creating value or not? That's essentially all you want to be doing. Okay? The goal in corporate finance is to really look at your firm in a picture like this and see whether your corporate actions you're taking end up increasing this box for your existing shareholders or not. So the slide I have, two pictures, ROIC on left hand side and R on right hand side. ROIC is what the firm generates, and R is what the firm is supposed to generate, and we want to maximize this gap. So in terms of financial calculation, this is it. Okay? This is as much as we need to know. So the next question is, and how the hell do we generate this gap? Yeah, how the hell do we get this ROIC minus R gap? Well, the answer doesn't lie in finance anymore. The answer lies in other sciences of business management. Switch back to this for now. So we call this a value driver. Okay? The value driver is really this gap, ROIC minus R. So how do we understand this value creation driver? Well, we can turn to, say, economics. Okay? We want to generate supernormal profit. What does economic theory say we need to do in order to get supernormal profit? All the roads in economics lead to one answer. Firm can only create supernormal profits if you are a monopoly. Okay. If you are the absolute monopoly, you can charge, where NC and NR need not be, well, they can be the same, but the price need not be at the break-even point because your demand curve, you face the individual demand curve instead. Now, I'm not going to dig down that far, but let's just take the insight that that's what economics tells us, and that's, I think, is insight that is both useful and true. Okay. Firms can create supernormal profit if and only if they create some unique values to the customers. Okay. Being a monopoly might not be as hard as you think. Okay. You can be a monopoly if you are the only person, selling pizza on this floor at this point in time. If somebody really wants pizza, then they must buy it from you. The problem is it might not be in a very big market. Okay, but sure, you're able to create economic profit for this very small market. So the question boils down to, is the balance between the addressable market size, is this market big? Okay, great, this market is big, but how much influence over the market do I have? How much market power do I have? You may have heard the framework, the five forces. Right. This came from Michael Porter, who is the father of modern strategy. They say the advantage is fundamentally the value of the firm depends on what it can create to buyers and also exceeds the value the firm creates. So they have a 5-force analysis. You guys get to see this, at least the equity guys must have seen this, right? So what are 5 forces? What do 5 forces say? Okay, bargaining power between firms and suppliers, bargaining power between you and customer. You and customer, how dependent are they on your product? Are you a monopoly? You and your supplier, are you the only buyer of this good in the market? Are you a monopson? Right. Threats of new product, barriers to entry. What's the other one? I forgot. Oh, sorry, substitutes. You get the idea. They all point to the same thing. How much control do I have over this market? The more control I have over this market, the better the market is. They don't say explicitly why, but you know why, because you can be a monopoly easily in this market. So to understand the business, whether this business is good or not, simply ask yourself this: can I become a monopoly in something meaningful? If you can, okay, great, then this business is good. Do they need me? Okay, am I rare or not? So these are like different strategies that firms can choose in order to deliver value to customers. Either you can be the guy who does this really, really cheaply. Could be economies of scale. Everyone comes to me to buy this. So, I have the cost advantage over other people. People might not want to pay so much for my stuff, but I have advantage in my production. Fine. People come to me because they must use this. Without this, they don't have anything else. So I can charge as much as I want. I am a differentiated product. So people do branding because they want to create the need for that product. Otherwise, without branding, okay, all toothpaste are the same. Maybe. They want you to believe they're not. They add this and that so that they're a little different. But that's to create a point of differentiation so that you think this is, to you, worth more than other alternatives out there. Or you can do focus strategies and so on. So I'm not going to dig down on this. So typically it ends up to a question of, are you offering something rare and unique? Goes back to economics again. Okay, you have scarce resources, unlimited ones. So people value more things as scarce. So the question is, how do you make yourself appear as scarce as possible yet still in demand? You can make yourself appear that, or if you yourself are like that already, that's even better. Sometimes this may involve inducing some barriers of entry. Okay, I do this, and once I'm in, I make sure I put up barriers so nobody else can follow me. Fine, that's also great. I did some businesses that I have natural barriers of entry. Like if I grant someone the right to build high-speed cables from north to south already, there may be no point for another person to do the same thing again because I have enough capacity. Or maybe pipelines or railroad. And before I go here, I want to go back a little bit about understanding the value creation. So the key lies in understanding the gap between ROIC and R. Right? So if we go back to what we've learned already earlier, how do we get this? ROIC equals NOPAT divided by invested capital. Okay, what I'm going to do after this is going to look very familiar to you. So I'm going to apply this by sales divided by sales. And hopefully recognize that, wait a minute, this looks exactly the same as the Dupont equation. Because it is. It is Dupont equation, but not with ROA, but ROIC instead. Same insight? Profit margin, which is revenue minus cost. And the next one is your efficiency. Sales efficiency. So what does sales efficiency means? It means if you were management of Starbucks 10 years ago and you want to drive your ROIC, how might you want to drive your ROIC? You can do this by profit margin, right? Increase price. The Starbucks coffee, if you think they're expensive now, they were a lot more expensive relatively before because the prices haven't changed so much. Because the other alternatives today have kind of caught up, so they don't look as expensive today. It used to be pretty expensive. So in terms of profit margin, it's pretty bad. So if I want to improve my ROIC, maybe I could go for the efficiency route instead. If you own Starbucks, own any coffee shop, do you think you're utilizing your invested capital efficiently? If you want to imagine Starbucks, you work as a barista in a Starbucks. You get one shift, your friend gets the other shift. Suppose you get an afternoon shift and your friend gets an early morning shift. Are your experiences going to be the same? No, because the early morning shift is going to be pretty much when everyone wants their coffee. Right? So when they open very early morning, people want coffee. So notice this, Starbucks tend to open very, very early, right? In most places. Even sometimes even earlier than local places. Anyone been to Taiwan recently? No? Anyone like coffee shop? When do coffee shops generally open? And where are you talking about? Depends on where you are, right? In Thailand, maybe coffee shop opens at around 7, say. You go to like third wave coffee shop, where the owner is also operating like a hipster cafe. When do they normally open? Yeah, let me tell you this, in Japan, in Taiwan, they open around 10 or 11. Right? What the hell, who the hell buys at this time? They're not really opening based on consumer convenience. They're opening based on their convenience. I don't want to wake up early. So I'm gonna come in my own time. If you like my coffee, come when I'm available. But if you are operating this as a corporation, you want to open this as early as you can because people want coffee in the morning. So it makes sense for you to open really early in the morning. But in the afternoon, the crowd dies down. So what do? You can close. Yeah, you can close if you want. That's one shop in Suan Long Square that sells the rice dumpling, bo loy. You've been? Sweet Circle. You have? Okay, when does Sweet Circle open? 5 p.m. When do they close? Around midnight. So they open at 5 p.m. and close around midnight. If you go around 3 p.m., you want to eat the rice dumpling, they don't open. Why don't they open? Because nobody goes there. Nobody goes there at daytime. It's really, really hot. But in the evening, a lot of people come, so they open just to open it, create a crowd. So you have a choice of closing down when people don't come. But you can close down, okay, you don't sell anything, but you still pay the rent on that place. You open or not, you pay the rent for 24 hours. You can open for 3 hours a day if you really want to, up to you, but you pay the same amount of rent. So if you want to have more traffic, what might you do at Starbucks? Imagine this is 10 years ago. You go to Starbucks, there's nothing but coffee and maybe bagel and some pastries. What might you do? Hire more staff? Less staff? Okay, want to keep the shop open, less staff, less operating costs. That helps in terms of cost. But suppose you want to sell more. Promotion, reduce price, okay, like in the afternoon, after 2, like that place in Jamboree Square, like tea. You know, there's actually a bubble tea shop right underneath the basement, somewhere very deep. Yeah, they have a promotion 2 to 4 p.m. Buy one get one free. So they do that because nobody comes around them. But if you don't want to reduce price, what might be another way to attract customers? Yes.
You can extend your portfolio.
Right. I'm selling coffee. People drink coffee in the morning, don't drink so much in the afternoon. But what if they come in and not buy coffee, but cakes and sandwiches? 10 years ago, Starbucks doesn't sell cake. 10 years ago, Starbucks doesn't sell any proper food items, just pastries. So if you come in the afternoon for cake, hey, I'm buying cake, I might as well buy coffee to go with that cake too. Fantastic. So afternoon sales goes up, great. Evening, I'm still paying rent, but evening nobody comes anymore. What do I do? What do people buy in the evening mostly? I heard already, right? What kind of drinks? Alcohol, right? So Starbucks now is fact, but about 5 years ago they started applying for liquor license. To sell alcohol, you need to be licensed to sell alcohol. So sometimes people don't do that because the cost of licensing could be high. But in the end, they do it. If you look at new coffee shops nowadays, a lot of coffee shops now sell coffee plus alcohol as well, because otherwise they can't have traffic all day long. That's sales efficiency. You have the same invested capital. I built my shop already. How can I squeeze the most out of my investment? That's why 7-Eleven doesn't close. I want to be open for as much or as long as I can because, well, people, I pay for all the investments already. Only some exceptions, like 7-Eleven doesn't open 24 hours a day, like Jamjuli Square, for example, because they're not allowed to. There are some places where they have restrictions that you can't open 24 hours a day. But this is what it means, okay? Sales efficiency, another way you can think about that is asset utilization. You have these investments, these are your assets, how can they make the best use of that? You can increase sales, keeping invested capital the same. Or you can keep sales the same and minimize invested capital. So you can build these down into little components. Like increase price, can I do this? Same cost structure, increase price. If I can, great. Can I reduce cost? Lean manufacturing, or cost rationalization. Do I have any duplicate costs? Can I find ways to do this more cheaply? Asset utilization or working capital minimization. So all these things are ways for you to increase your ROIC. It's another gap on the right hand side. I want to make sure my ROIC is greater than R. I want to reduce this. Okay, so how do I do this? So I can do this by capital structure. Other ways for me to do this so that I get some advantages and reduce my cost of capital. My firms might be exposed to some risk. My investors might be exposed to some risk. I might not be very well diversified. I'm going to reduce some risk so that once I do this, okay, I can increase value to my company, which is reflected by an increase in perception of risk by investors. This hopefully gives you a good overview of what we can do to maximize firm value, both in terms of business strategies and also in terms of financial strategies. Now, I know this is a finance course, but to do these case discussions, most of the time invokes you understanding the business model and business first. Right? What is the business doing? What problem is it solving? And is it in a good business? And then once we understand that, we can recommend some strategies for the firm so that complemented with financial recommendations that we make to them allows them to create more value to shareholders. So I want you to think about all these issues too before you analyze the case. Yes, they all involve financial decisions in the end, but the right financial decision comes from understanding the existing situation of the firm's business as well. I'm going to go back to the gap earlier. I told you the gap between ROIC and R is what we would like. So one way to measure how much value the firm is creating is looking at this gap as percentage and then multiplying it by your capital you have and get a dollar value, a dollar estimate. Okay, so this is a per dollar value creation. My cost of capital is 10%. Okay, it costs me 10% to raise all this capital to do the business. But with the business, the capital that I raise and I employ, I'm able to generate 12% on this. So the gap between ROIC and R tells you the measure of value creation per unit of capital employed. Then if you multiply this by how much capital you're employing, you get a dollar estimate. The value you're creating, we call this EVA, economic value added. Its economic value added is another way of thinking about the economic profit. Actually, it's not another way of thinking. It is the economic profit. Economic profit generated per period. So in each period, I'm looking at all these examples as if it's a perpetuity example, but it's very unlikely that firms, since the day it starts, begins delivering value to its investors. Think of Uber, think of Grab, think of tech companies you've seen recently. Actually, think of any small companies at all. Typically, in the early days, it tends to be the days where they start building their names. So the profitability may not be there. But once you achieve domination, then it's time for you to get your money back, so to speak. So you might want to be not tracking ROIC as is today, but you might want to be making a forecast of what your performance might be into the future, and then see. And if at some point your ROIC turns to be greater than your cost of capital, then your business is great. Right? Because otherwise, if you evaluate business as is, then none of the businesses around today would have been here because they had a slow start. So that's the EVA. And the way we derive this, I think I went a little too fast here. You can understand it from two steps. Okay, the first step is understanding what is your profit, NOPAT, EBIT times 1 minus tax. Then understanding how much do you have to repay to your capital providers. So you have your invested capital, then multiply by the cost of capital that it costs you to raise. Then you get capital charge. Profit minus capital charge is economic profit added, which gets us to the formula earlier. So this is a period by period economic profit generated. Some period this may be negative, but hopefully, once the firm reaches a stable stage, the firm should be creating sustainable positive economic profit. Otherwise, there's no point in having that firm at all. So if this is economic profit, the value added, we can imagine a firm as the original capital you provide to the firm. Say the 10 million baht seed capital to start. And then another layer of future benefits, future economic profits a firm is going to generate. The present value of that added to the existing value of capital, that will give us the enterprise value or the firm value. So you can do a little proof and see with EVA formulation, you can plug in okay, the firm value, essentially the original capital plus the future economic profit you're going to generate, and when you do the simplification, it boils down to the same thing. So this is a quick proof that you can look at this from economic profit perspective. When you can look at it from the free cash flow perspective, the ending result is the same thing. So this helps you okay, when you do your projection. If you know how to calculate EVA, economic profit, you can modify okay, your financial projections of the company so that you don't look at the free cash flow alone, but you look at the period by period profit creation. If your company is generating profit, it's great. But if your company is generating too much profit, which is possible, then your valuation may not be realistic. Because one thing we have to bear in mind is that it's good to create economic profit, yes, but is economic profit always sustainable? I want you to imagine some time ago a company called, what is it? Roti Boy. When I bring up that name, what experience comes to your mind, Roti Boy? Long queue. Okay, Roti Boy is actually a Malaysian bakery, right? And what their specialty was back then was a coffee butter bun. So for those of you who were into this craze, you might have remembered either lining up yourself or paying somebody else to line up for you, because you had to wait hours to get it. My next question is, where is Roti Boy now? Back to Malaysia. Not here anymore, right? So was Roti Boy a successful business? Was it profitable at that point? Pretty sure, right? When you bake anything out, within minutes it's all gone. It's really profitable. But why is it no longer around here? Roti Boy is not here, but who's here? Bun, Mr. Bun, right? Selling pretty much exactly the same thing, but just not called Roti Boy. You get copied. When you're successful, you can create economic profit. Yes, great. In the short run, remember in economics, in the short run, it is possible to create supernormal profit. It's possible to create economic profit, but without the right sources of sustainable advantages, people learn from you. They want to share your success, and the total pool of profits available to be shared gets affected by that. So that means if you do your projection and you're able to calculate your free cash flow forecast, you can also calculate your economic profit that you're expecting to get on a per period basis. And if you find that you are projecting an ever increasing economic profit, and your business, your industry, somehow doesn't support the view that in 5 years, 10 years from now, you'll be the most dominant firm in this industry, you might be fooling yourself about how successful your company really is. And so usually I would go through a workshop with you on how to do this, but I'll show you, right, how you can reorganize financial statements. You can make forecasts about what's going to happen in the future. You can also rearrange them to get estimates of free cash flow and economic profit too. I don't require you to do this in class, economic profit, but if you have to do this in real life, when you try to value a company, it helps that you do a little check that, am I being too optimistic about the forecast? If I'm assuming an insane amount of economic profit to be created, is it really reflective of reality? A few final points I want to add. Okay, we want to maximize value. Most of the time you don't actually see value. When you open your Z streaming app, you see a stock quoted as something. That's actually stock price, not stock value. So what's the difference between stock price and stock value? Okay, and that is your definition of. So let me ask you this: when you open a stat streaming app, you see some stocks is priced at 35 baht. Why is it selling at 35 baht? So somebody might think that, right? Actually, the answer is a lot simpler than that. No need to overthink this. Why is it the stock price shows a number of 35 baht on screen? Because somebody else just recently bought this stock for 35 baht. That's it. That is price. Price is what you pay for something. Okay? What you pay for something might not have to be reflective of anything at all. Okay? I gave this example in my MBA class. That bottle of water. If I give you a new bottle of water, how much are you gonna pay for this? 7 baht. Why everyone say 7 baht? I'm actually curious now. Why 7? What's so special with 7? Sorry. Everyone buy this price at 7-Eleven. Okay. Average price. I'm just curious. Every class I ask, everyone say 7 baht. Precisely 7, not 10, not 5, 7. Okay. Actually, somebody told me there's a law or something that say if you sell water, there must be at least one variety that you sell for 7 baht. The others you can sell as expensive as you want, but you have to sell one at least for 7 baht. Right? Especially at airports. You have a 7 baht choice. Okay, 7 baht. Okay, you pay 7 baht for this, but if you have to pay higher, are you willing to pay higher than 7 baht? If it's mineral water, so on, right? What I want to get at is that you have your internal valuation of what the value of this bottle is for you. Okay, and as long as the value of this bottle is greater than 7 baht, somebody is quoting you, you'll be willing to pay for that. Because if you have a value of this 2 baht, then I sell to you 7 baht, you say no thank you, because I don't think it's worth it. Everyone have their valuation in their own mind, and this may be 7 baht exactly, but for the people who buy at least, it will be at least equal to 7 baht, otherwise you would not transact at all. Same thing with stocks. Okay? You have some valuation for the stock. If the stock is buying and selling at 35 baht for now, okay, and your valuation is greater than that, you would buy. Right? You can buy in the market for 35, but I think it's worth 45, so it's a good deal. This is what we mean by buy low. Right? Lower than my valuation of this stock. On the other side, if this stock is selling at 35 baht, but my calculation, my estimated cash flow and so on, say it's only worth 25 baht. I'm not going to buy this. In fact, if I own this piece of stock, I'm going to sell it. So that's why I said in finance, it's as simple as comparing some number to what it is supposed to be. Right now the price 35 is supposed to be 25, so not good deal. You should sell instead. Right now it's 35, but it's supposed to be 45, so very good deal. Let's buy. We have some mechanical way of finding out what that number should be, but that's essentially the comparison we make at the back of our mind. What makes financial market different from bottled water market is that in the bottled water market, anyone who comes into my shop, I have to sell that at 7 baht. Okay, I put 7 baht on that. If you don't agree with me, you don't have to buy from me, but the price is always going to be 7 baht. In the financial market, who gets to set the price? Last guy. The guy who just transacted is the guy who sets the price in the market. Okay, so in normal market, price is not equal to value. Price will not equal to value, because if you price right equal to value, then you're going to have a very small market. You want most people to have a higher valuation than how much you're charging them. In fact, that's the whole point of marketing. And you want to have higher perceived value compared to the price you're charging, because the gap between your perceived value and the price they're charging is your consumer surplus. Okay, you want to have consumer surplus when you buy some stuff, so that's why they try to make very big efforts in convincing you this is really valuable to you. And then they charge a fixed price. Hopefully your valuation is very high, you're going to come and buy it from them. In finance, the objective is a little different. Okay? When you value something, it doesn't really depend on what it is, what it means to you. Because when you value a bottle of water, if you value minerals, you prefer mineral water, but other people might not care about that. I just want to be hydrated. So for the same bottle of water, my valuation can be very, very diverse. But for stocks or assets, Okay, we value that based on estimated future cash flows. And how do we estimate future cash flows? Assumptions. Where do you get assumptions from? Market. Maybe research. Which most of them you get from Google. Everyone gets information from the same place. Right? Even news. Some proprietary. How do you find about this? Oh, I Googled them. If you can Google it, everyone can Google it too. Many chances are when you want to put a valuation on something, your assumption is going to be very similar. Your valuation of these stocks of these assets is going to be very similar. And if you get to transact based on your belief about the value and the current market price, then most of the time price and value will be very similar in the market. Because when we disagree that price does not equal value, we transact, either buy low or sell high. So that's why we learn finance. A lot of people talk about price and value as if they're the same thing. In fact, they are not. Okay? Value is what is worth to you. Price is what you pay. They need not be the same. But in financial markets, most of the time, price equal value. Because whenever price isn't equal value, somebody fast enough will be able to transact. And then with the forces of demand and supply, prices will correct so that it reflects, okay, the latest guy's value. And if the latest guy's value is shared across everyone, it becomes, a common market belief as well. So that's the main difference between price and value. Right? Price is what you pay, value is what you get. Like Warren Buffett said, for water wars are very easy, but for financial investments, the two can be very close to each other, just like a picture. Suppose you have two lines. Okay? The first line is the value, the dotted line here. As you can see here, the author is very careful in drawing that line and want to make the dotted blue line very stable. Because value should be stable. Value is how much this company is worth. So you compare the value of a firm yesterday to value of a firm today. Very similar. Unless something drastic changes. Okay, say Channel 3, before about last year, when you were reading about stock report about Channel 3, it's a free TV. Free TV everywhere around the world is facing the same existential threat. Why do I watch free TV when I have Netflix, when I have YouTube, when I have other streaming services, Line TV and so on? So free TV around the world are actually facing big troubles right now, and Channel 3 is the same. Then suddenly, Bhupesh Aniwat comes along. Right? Biggest rating ever seen in the history of Thai television. The history of Thai television. Everyone watches that. What happened to the stock price of Channel 3? You get to see Onokun Man's article, goes up. What happens when Bhupesh Aniwat stops? Goes back down again. So why do you think stock price went up? There are two explanations. I think, at least. Let's talk about them. Why do you think stock price went up when Bhupesh Aniwat had
Because there's more viewers
the
now.
value? The what, sorry?
So since there's more people watching, the cost for advertisement will go up. So
Right.
revenue should go up.
Right. But the valuation of the company that it went up by is a lot more than the advertising revenue they got from the show. So what might be investors thinking?
Perception.
Sorry?
The perception has gotten better.
Right. So maybe Channel 3 has now reinvented itself. It's able to find a success formula that will be able to deliver this success over and over again. So valuation goes up. I see a different value. As the play, as the show dies down, it's over, but it's not really over, because for those of you who are fans, you will notice there are actually 3 more episodes after. What about those 3 episodes? They're the same. Reruns of the same thing. So if you're an investor, you might think, wait a minute, have they really found a success, or are they just milking everything off that they can? Maybe I'm not so confident about them anymore because I saw a preview of what's gonna come next. I don't think I want to watch this anymore. That was a one-time success. So stock valuation goes down. Right? That's one explanation. Maybe value goes up, value goes down. Other explanation could be, within channel 3, they know that this is a fluke. They know that they can't do this again. But if everyone wants to buy it, fine, you can buy it all you want. But when it comes back down, it's just recorrecting itself back to level again. Actually, we have no way of knowing this because we only get to see the price, not the value. If somehow we're able to kind of uncover the truth about a company and find the line, the blue line here, you would know that, okay, this is the company true value. So right now, the stock price is going up like this. It's just a hype. Deep down inside, it's no, yeah. I don't know what you guys are excited about, but if stock price goes up, it's fine. Maybe I'll just sell some of my stocks at this point in time to benefit from this. But sometimes you might want to track, okay, what insiders do. In the world that deviate from assumptions, we have asymmetric information. Insiders and outsiders, they don't have the same set of information. We as outsiders might get very excited about the firm. We might have a hyperinflated value, a distorted perception of reality. We buy at that price. But insiders know, well, I don't think my firm is worth that much. So if you want to buy at that price, fine, buy my shares too. So sometimes people track, okay, the movements of insiders. In Thailand, we have to report. Okay, if you are company's executives or related to company executives, you have to file, I think, 56-2 or something. I don't remember what form called exactly. We have to tell the stock market that here are my transactions, I'm buying and I'm selling stocks. Okay, so sometimes people watch that and then take that as an indication of, is this the right time? Are stocks overvalued or undervalued? One of my early advisees look at this, right? Look at the insider, okay, trading information, and then see if they're able to transact at higher or at better prices than other people. And it turns out, yes, they can. Okay, so I don't think we should be surprised. Okay, inside info matters a lot. That's why people have laws that back insider tradings. So if you're able to discern this, it's great, you can do it. And that's what analysts do all day long. When they pick target prices and so on, you learn what you learn in your equity class, essentially what you're doing. And you want to have a view of this line internally so you know what to do with this stock. Thankfully, what we learn in class, okay, if we know the information to be processed and analyzed, okay, if we think about this as a numbers exercise only, not relying on any insights at all, the calculation is very simple. You guys have done this over and over again. Plug in the numbers, find the present value, here's the value of the firm. So there's a startup in Thailand that is showing this line to assist investors in making decisions. You guys know, right? Jitta, right? Jitta, Jitta. Startup company that tries to come up with this line, and I don't think they use anything more advanced than what we will learn in class. Now, how informative this is, there is no way for you to know what this dotted line is. And I think this is one of the most important learning we can take from this class is that valuation, you can do as well as you want, but this blue dotted line is a conceptual line. You will never be able to find what that line really is, and even if someone says they can find this, they're bullshitting because there is no way for anyone at all to know what the value of something is. You can have the number up to your best satisfaction, but you can never be 100% sure. We're going to learn a lot about valuation techniques in this class, and the reason why we learn about a lot of them is because when we want to find a value of something, okay, this blue dotted line exists, but we have no way to really verify whether we arrive at the right destination or not. So the best thing we could do is we think of us as shooting for the star that we know exists, but we have no idea if we ever got there or not. So different valuation techniques means you try shooting using different ways, and if you end up in the same neighborhood, then you know, right, the right destination should be around here. You can never pinpoint that you arrive at that destination. And that's why you see a lot of different valuation techniques. And then in the end, it's up to us to use judgment to exercise what number are we happy with. Because in the end, all these valuation is done to assist in decision making. Whether you take that leap or not just depends on your final, judgment in the end. You may have a valuation that's higher than me, but in the end, it comes to negotiation between us. This is the number we're happy with. Might not be the best number we want. We'll be happy with this number. That's fine. Okay. So in this class, I don't want to focus so much on the techniques, because we're going to learn techniques are all very, I guess, mechanical. Okay, you have a model, you plug in numbers, you're done. That's it. So most of the work in valuation relies on convincing the audience that you've done the right job. A job in finance is actually a job in sales, because you're not really calculating much. You're selling your ideas. You're selling your work to other people. It is probably more art than science to succeed in this business. So that's why, okay, I want you to focus on the surrounding business ideas in the cases that we do as well. Because in the end, it's about building a convincing case to your audience. You can have all the right models that you want, but if you're not able to sell that to your client, you might as well not come here, right? Okay. So it's just a final point to close things off. You may have heard the word efficient markets. Efficient market hypothesis just means when you look at prices. Prices are meant to reveal something, meant to reflect information. Yeah, weak, semi-strong, and strong form. The thing that I want you to learn about the most is that market prices react to future information, and it is a process, and then action is taken today. So if you have something that you think the firm is going to do, even if it hasn't done yet, okay, it will take effect today. I was listening to a podcast, Money Planet. There are a couple of podcasts I really recommend that you listen to, and also one TV show when you have time. The podcast is about tax. It's about tariff war between the US and China. One of the items they talk about they're going to have a tariff war on is soybeans. Okay? And the United States is one of the biggest exporters of soybeans in the world. When you eat tofu, when you drink all lactose soy and all those stuff, chances are we're eating US soybeans. Hopefully not genetically modified, but they do that a lot. Now China is coming out with a, if you've been following the news recently, President Trump and President Xi Jinping have been engaged in a war of words, and I'm going to put up tariff on you, and then retaliation and so on. But actually nothing has happened yet. Right? No tariff has been erected yet. But a lot of things that they say they would do has come out, and one of them is soybeans. So the moment soybean appears on the list, China is one of the biggest buyers of US soybeans. Nothing has happened yet, but they just say this is what we're going to do, but they haven't done yet. The Chinese buyers say, well, we can't afford this because the soybean business is actually a very cost-driven business. A very small change in price, I'm not going to buy from you anymore, I'm going to buy from someone else instead. So if in the future US soybean is going to cost a lot, I'm going to buy somewhere else instead. And the second country is Brazil. So in Brazil, if you're a soybean farmer, you have a really good time for no reason. Nothing has changed in the world, just two guys exchanging words. Suddenly all the Chinese soybean buyers are now flying to Brazil to buy the soybeans in fear that the tariff war is going to happen. The same thing in finance, right? If you believe something is going to happen, even though it hasn't happened yet, you're going to pay for the prices today. Good news, price up, value up. Bad news, value down. You thought it was going to be good news, now it's bad news, value used to be up, now value is down. Okay, so value reacts to changes in market information. And we're going to see, okay, in the cases that we do, that sometimes when companies come out and announce, I want to do this, stock markets will react almost immediately, and when the firm ends up doing those transactions, there's no value to be created. Value creation or destruction is instantaneous. The moment you announce, and if the market believes you, it's done. Right, so I think that's pretty much all the background that I want to lay on to you now. After this, it's just going to be the cases that we have to do. So I would like you to arrange yourselves into groups, because next week I would like you